GDP growth estimates came in as a pleasant surprise for the quarter ended March of this year. At the same time, the RBI feels that time is not yet ripe for a rate increase. Under normal circumstances, these pointers would augur well for the Indian economy, but we do not live in normal circumstances. Every single day is very different from any other, thanks to geopolitical tensions. So given all of this, we do have to brace ourselves for a potential turn for the worse. Hello and welcome back to Business Matters with the Hindu with me, K. Bharat Kumar. Growth estimates for the March quarter of this year came in at 7.8%, and for the full year, India is estimated to have grown at 7.7%, and this compares with the 7.1% seen in the previous year. Manufacturing and services did well, as did private consumption expenditure and gross asset creation. But estimates for agriculture were that the sector grew at an anemic 3% compared to a 4.2% in the previous year. The Reserve Bank of India, in its bi-monthly monetary policy, chose to hold rates steady. It did not increase nor decrease the benchmark rates. Why did it do that? You'll have to remember that the mandate for the Reserve Bank is to keep inflation in check. It has been given a range of 2% to 6% and keep inflation preferably at or close to the midpoint of 4%. Given this context, here's what the governor said, and as he laid out the reasoning behind this month's decision. The Monetary Policy Committee of the Reserve Bank of India said the global environment had deteriorated since its meeting in April, with the conflict in West Asia lingering amidst a fragile truce. The impact on supply chains and high energy prices is reflected in the moderation of growth and increase in inflation projections compared with what it laid out in the April policy. The central bank estimates that India's economic growth will come in at a mere 6.6% for the year ending March 2027. Remember that this is much lower than the 7.7% that we just clocked for the recently concluded financial year, and it's lower than the 6.9% that the RBI is estimated for the current financial year. It had estimated this 6.9% in its April policy meeting less than 2 months ago. The RBI's MPC also warns that prolonged global supply chain disruptions, volatility in global financial markets, and weather-related shocks continue to pose downside risks to the domestic growth outlook. And if you want to know what these weather-related shocks are, please refer to our Business Matter episodes, the immediately preceding one and the one before that, where we dwelt extensively on the El Niño phenomenon and its impact on our southwest monsoons, which have already been delayed. Consumer inflation continues to be well below target despite the geopolitical tensions because the pass-through to domestic prices has been limited. The RBI does estimate that inflation will quicken and will peak in the Q3 of this year, that is the October-December quarter. But it also estimates that the geopolitical impact will start to wane from Q4, which is the January-March quarter. The Reserve Bank estimates that for the full year, inflation will be at 5.1%, which is still below the upper band, which is 6% of the RBI's inflation mandate. The Reserve Bank, of course, flags risks due to global supply chain disruptions, global commodity price shocks, uncertainty about the distribution of the southwest monsoon, and El Niño conditions as potential disruptors. RBI's estimate for the current fiscal's inflation, which it made in April, was 4.6%. Signs of the war in Iran are already beginning to show up in India's fuel fortunes, either in price or usage of petrol, diesel, and LPG. India's LPG consumption came in at a 5-year low. An article in Business Line tells us that the consumption was the lowest in 62 months, the previous lowest having been observed in the COVID-impacted month of April 2021. Interestingly, both petrol and diesel consumption was higher in April over March and higher in May over April. Aditi Nair, chief economist at ratings agency ICRA, says that GDP growth exceeded ICRA's own estimate of 7% for the March quarter. However, she points out higher energy prices for an extended period does pose risks to growth. This includes muted prospects for investment demand, negative impact on corporate profitability, and dampened consumer sentiment. Besides, the potential development of El Niño conditions and a weak monsoon forecast for 2026 have dulled the agricultural outlook and rural demand prospects for the second half of this fiscal. The same ratings agency ICRA points out that the current account received a surprise surplus tag for the March quarter, driven largely by a 31% surge in remittance inflows, which were at a record high. This exceeded even the inflows via remittances for the December quarter by a healthy 17.5%. But the agency also points out that negligible net capital inflows were a dampener in the full fiscal 25-26. ICRA expects the current account deficit to double in 2027 relative to 2026 because of the pressure on energy prices following the conflict in West Asia. This will trigger a further weakening of the rupee, which has already struggled against the dollar thanks to the conflict in Iran. It will impact our import bill, especially that of an already pricier crude basket, as well as challenge our forex reserves. That brings us to the Did You Know section that we have for you in every episode. Did you know that India began reporting GDP numbers first starting in 1949? And here's the quiz question related to that nugget of information. Who set up the Indian Statistical Organization that first put out the GDP numbers in that year? Look out for the answer next week. And here's the answer to last week's question. The question was, who invented the first ever seed drill of 1701? The answer is Jethro Tull. That's all we have for you folks in this episode. If you enjoyed what you saw, do not forget to like, share and subscribe. Until we meet again next week, have a wonderful time ahead.